Welcome back to The Explainer. Okay, I am absolutely thrilled to have you here today because we are tackling a really fascinating detective story in the stock market. Today, we're putting Applied Materials, ticker symbol AMAT, right under the microscope. Look, if you've been following the semiconductor space, you already know the stock has been on an absolute tear. Prices are soaring, momentum is literally white hot, and it begs a very serious question. With a run-up this massive, is it just way too late to buy? Are we looking at a hidden bargain here, or is this stock dangerously overpriced? Well, we're going to let the data answer that for us. To figure this out, we're inspecting 6 key areas: the explosive price action, under the hood at profitability, the fortress balance sheet, paying for perfection with valuation, the dividend bonus, and finally, the final verdict. Section 1. The explosive price action, a decade of massive momentum. Okay, let's just dive right into this. 2,042.98%. That is the 10-year total return for Applied Materials. I mean, wow. If you had parked your money here a decade ago, you wouldn't just be beating the market. You'd be in a completely different stratosphere. That actually works out to a compound annual growth rate of over 35% a year for 10 straight years. It's exactly the kind of flashy, high-octane exterior that immediately draws a crowd. And you know, the momentum isn't just ancient history, it's happening right now. In 2023, the stock was up nearly 68%. In 2025, up almost 60%. And as of this data set in early May 2026, the stock is already up 51.59% year to date. So the car is speeding up, it's not slowing down. But as any good mechanic will tell you, a shiny paint job and a fast quarter mile don't actually tell you if the engine is built to last. So, moving to Section 2, under the hood profitability. Is the engine running smoothly? To answer that, we're going to look at the ultimate measure of corporate efficiency, return on invested capital, or ROIC. Simply put, for every dollar of capital this company reinvests into its business, how much profitable return is it generating? High ROIC means the company has a massive competitive advantage and a really highly tuned engine. And look at this, Applied Materials delivers a stunning 27.32% ROIC. That is elite territory, folks. Combine that with a net profit margin of almost 25%, and you realize that AMAT isn't just riding some hype wave, it is a literal cash-generating machine. For every $100 of revenue it brings in, 25 drops straight to the bottom line as pure profit. The engine is immaculate. Section 3, the fortress balance sheet. Let's check the structural integrity. Because a fast car is great, right? But it absolutely needs to survive a bump in the road. On the left, we have a current ratio of 2.71. This just means that for every dollar of short-term liabilities the company owes over the next year, it has $2.71 in highly liquid assets just sitting around to pay for it. So short-term risk, virtually non-existent. Then on the right, the debt-to-equity ratio is 0.30. That is incredibly low long-term debt. They are not leveraging their future to pay for today. This is what massive structural resilience looks like. Section 4. Paying for perfection, valuation. We're looking at the sticker price. Now, notice the tension in these metrics. The current price-to-earnings ratio is 39.82. That's a pretty steep price to pay for a hardware-oriented tech company. But more importantly, check out the difference column. That PE ratio is over 60% higher than its own 3-year historical average. And the price-to-sales ratio is at 11, which is nearly 75% higher than its 3-year average. So the market is pricing the stock for absolute perfection. If you buy right now, you're paying a massive premium compared to what investors were paying just a few years ago. But wait, hold on. Before you walk away from the dealership in disgust at that sticker price, consider the PEG ratio of 1.43. This factors in the company's earnings growth rate. While the standard PE ratio is soaring, the PEG ratio is actually down nearly 77% from its 3-year average of 6.19. Why? Well, because AMAT's earnings per share are growing at a massive 75% trailing 12-month rate. Yes, the valuation is high, for sure, but the raw growth of the underlying profits might actually be strong enough to justify a good chunk of that premium. Moving on to Section 5, the dividend bonus, a steady, reliable yield. Now, I know at first glance, a 0.55% dividend yield isn't exactly going to make you rich overnight. But check the underlying mechanics here. They've raised this dividend for 8 consecutive years. And more importantly, that dividend is growing at over 15% a year. Plus, because the engine is so ridiculously profitable, paying out that growing dividend only eats up 19.43% of their earnings. That payout ratio is rock solid, meaning this dividend has miles of runway to keep compounding aggressively for years to come. Section 6. The final verdict. Fair value. Time to consult the Kelley Blue Book. This is the question we started with, and honestly, it's the one every investor faces. When a stock's historical valuation averages are flashing red, telling you it's trading at a 60 to 70% premium, well, instinct tells you to run away. It tells you it's just too expensive. But what does the company's future cash flow actually say? It says this, $521.07. That is the calculated intrinsic fair value of Applied Materials based on its actual free cash flow generation. Now contrast that against its current closing price of $389.08. Despite the soaring PE ratios, despite the seemingly stretched valuation multiples, the sheer volume of cash this company produces means its true intrinsic value is remarkably higher than what it's trading for today. And let's visualize how this builds your investment cushion. At current prices, you are buying this phenomenal, well-oiled machine with a massive 25.33% margin of safety discount built right in. You actually have a massive buffer. The historical metrics might suggest the stock is running hot, but the intrinsic cash flow tells us there's still substantial room for this stock to grow into its true valuation. Which leaves us with this final, provocative thought to ponder. Does a $521 intrinsic fair value outweigh those historical valuation constraints? As a focus learner, you now have the data. You have to decide if you trust the rearview mirror, which says the stock is trading way above its historical averages, or if you trust the road ahead, where the intrinsic free cash flow dictates a much higher ultimate price tag. The tension between those two metrics is exactly what makes investing so incredibly fascinating. Thank you so much for joining me for this explainer, and I really hope this structured look at the data helps you navigate your own financial journey.